Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Small Limited is expected to have earnings next year of 129 million shillings. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. So we have 3 years expected results: sales, cost, cash costs, capital allowances, interest charges. We have cash flows to replace assets and finance growth. Additional information number 1. From year 4 onwards, from the 4th year onwards, it is expected that the annual cash flows from Small Limited will increase by 4% each year in perpetuity. Number 2, tax is payable at the rate of 30%. Tax is paid in the same year it falls due. 3, if Duet Limited acquires Small Limited, it estimates that gearing after the acquisition will be 35%, measured as the value of its debt capital as a proportion of total equity plus debt. 4, the cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. 5, the risk-free rate of return is 6% and the return on the market portfolio is 11%. Required. Roman 1. The offer price for Small Limited, assuming Duet Limited chooses to value Small Limited on a forward price earnings multiple of 8 times, 2 marks. Roman 2, the cost of capital of Duet Limited, 4 marks. Roman 3, determine the offer price for Small Limited using discounted free cash flows valuation method. That is the question. All right, 8 marks. Now this one was relatively the easiest question in this sitting. It was relatively the easiest because question is direct. It's very direct. Look at Roman 1. The offer price for Small Limited, offer price. Assuming Duet chooses to value Small Limited on a forward price earnings, right? That is the PE multiple of 8 times. Now that means that Duet Limited is considering buying Small Limited and is issuing or using evaluation method based on the forward price to earnings ratio. Forward price to earning ratio. This is only 2 marks. I'm just taking time to explain, help you understand the question. But the answer is very simple. We just take 8, then multiply by the earnings of this company. It will be 129 million times 8. That is the answer. But I'm taking time to explain so that you understand that the forward price to earning ratio is a method that is used when valuing targets. Okay? The Duet is going to use evaluation method based on the forward price to earnings ratio, and the candidates in valuing the target, the company estimates a company's value by looking at its predicted future earnings. Predicted future earnings. That's why in the first sentence we read that this company is expected to have earnings next year of 129 million. You understand? So this is the answer. This is a Roman B Roman 1. The offer price. The offer price. The offer price will be equal to earnings of the target times the PE ratio. And the earnings of the target, from the first sentence, we get the earnings of the target, 129 million. So 129 million times the ratio. The PE ratio is 8. The multiple is 8 times 8. And that is the answer. 2 marks. We just picked it directly. A forward price earnings multiple of 8 times. So how much is it? 1032. That is 1 billion. 32 million. 1032. 1 billion. 32 million. 1 billion and 32 million. Yes. Agostino, that is correct. Kelvin, that is correct. So that is the answer, 2 marks. Roman 2, the cost of capital. The cost of capital, Roman 2. So when you have such a question, step number 1, put down the formula. Cost of capital, Roman 2. We are to calculate the cost of capital. Now, this is a geared firm. It is a geared firm. And in Roman 3, we read that if Duet acquires Small Limited, it estimates that the gearing after acquisition will be 35%. So the proportion for debt will be 35%. Okay, which means the proportion for equity will be 1 minus 35%. So this is a geared firm, and therefore we have to calculate the weighted average cost of capital. The cost of capital of a geared firm is the weighted average cost of capital. The weighted average cost of capital, which is equal to the weight of equity, weight times cost of equity, plus weight of debt times KD. That is the formula. So first of all, put down the formula. So the cost of capital of this firm, given that it's a geared firm, will be the weighted average cost of capital. And this is the formula for the weighted average cost of capital. Then we check from the question if we have the weights. And we have just read in note number 3 that the weight for debt is 35%. If the weight for debt is 35% proportion, then for equity will be 65%. So we have the weights. These weights we can pick from the question. Then do we have cost of equity? No, we do not have the cost of equity. What if Agostino asks, what if it was not a geared firm? How would the formula be? How would the formula be? If it was not a geared firm, it would depend, Agostino, on the information provided. And I'm just going to show you right away. Assuming that it was not a geared firm, then the cost of capital will be the cost of equity. Okay, if it was not geared, that would mean that the capital structure, in the capital structure of this company, will only have equity, and therefore the cost of capital will be the cost of equity. Is that clear? Now, to even illustrate it, Agostino, let us assume there is no debt. Let's assume there is no debt in the capital structure. Therefore, what will be the cost of equity, given the information we have? You can see from this formula, we have the weight. The weight of equity is 0.65. The weight for debt is 0.35. Do we have cost of debt from the question? Yes, in Roman number 4, there is cost of debt of 7.4% before tax. So this cost of debt is 7.4. So we multiply this by 7.4% before tax. And what is the tax? The tax is 30%. So we deduct it. 1 minus t is 0.7. So this will give us a element of debt. Then we have to calculate now the cost of equity, which we are not provided in the question. And that is what Agostino is asking. What if it was not geared? What if it was not a geared firm? How would the formula be? Now, Agostino assumed that this one is not, it is not geared. We only have equity, this equity. What will be the formula for calculating equity? Now, to calculate equity, we need the working. To calculate this cost of equity, we need to have a working, and we are going to use the CAPEM formula. Using CAPEM, KE should be equal to RF plus RM minus RF times beta, equity beta. So we have to use this CAPEM formula to calculate the cost of equity. Now let's check from the information provided. Do we have the risk-free rate? Yes, note number 5. The risk-free rate is 6% plus. Do we have the return? The return on market portfolio, we have it 11% minus 6. Then there is a note number 4. Equity beta is 1.6. So that is the cost of equity. How much is it? What is the rate? Hope says 14%. 14%. Is that true? Can someone confirm? Is it 14%? I need confirmation. Correct. So this is the cost of equity, 14%. With that, we can now calculate the weighted average cost of capital. How much is it? 10.913%. Correct. 10.913% is the cost of capital. Is the cost of capital, 4 marks. Cost of capital, 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. Can we proceed? I told you it was one of the easiest of all the questions. Roman 3. Determine the offer price for small limited using discounted free cash flow valuation method. And you can see, candidates, this question is directing you. Discounted free cash flow. That tells you that to determine the offer price, you are going to discount the cash flows. Discounted free cash flow valuation method. You understand? The offer price for small limited using the discounted free cash flow valuation method refers to the present value of small limited's projected future free cash flows. And in essence, the discounted cash flow valuation method aims to determine the intrinsic value of small limited based on its ability to generate cash flows in the future. And this method is widely used in mergers and acquisitions because it provides a comprehensive and theoretically sound approach to valuation of companies. You understand? So we're going to discount the cash flows, and the cash flows are provided in the question. Look at the second sentence. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. Okay? So, Roman 3, the offer price. Okay? Offer price. Now, to calculate the offer price, we have seen we are going to discount these cash flows, and that will enable us determine the offer price. So you can see from the question we have 3 years. So one column will have years. There are 3 years. 1, 2, 3. Then the next column will have the cash flows in thousands. We'll have the cash flows. These cash flows. Then we'll have the present value interest factor. The present value interest factor. And the rate that we computed in Roman 1, that will be the discounting rate. This is the discounting rate. Okay? Present value interest factor, 10%, 10.913. N. Then we'll have the present values. We'll have the present values in thousand. So that is the formula. Okay? Are you following? To determine the offer price using the discounted cash flows valuation method, we'll have the years as given in the question. We'll have the cash flows, the future values of cash flows year 1. We will discount using the present value interest factor, 10.913%, N. Then we multiply by this factor by the future values, That will give us the present values. Then this total down here will be the answer. That will be our answer. So that is the formula. Okay. Cash flows. Can we proceed? Can we proceed? Can we proceed? Are we on the same page up to that point? Year 1, year 2, year 3. But you recall there was a statement on something to do with year 4 onwards. Yes, not number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year in perpetuity. So from year 4 onwards, there is year to perpetuity. From year 4 onwards to perpetuity, they will also have the cash flows. So do we have the cash flows? No, we do not have the cash flows. We have the sales, the cash. So we need to calculate the net cash flows. So we are going to have a working for the net cash flows here. Workings. We are going to calculate the net cash flows. Net cash flows. The net calculation of net cash flows. We are going to have calculation of net cash flows. That is the working. Because here we have sales, year 3, year 3, year 2, year 1. Thousands, in thousands, in thousands. So what we have here, we have sales. These are sales. 300 million. 300 million. 420 million. 480 million. After sales, there is a cash expenses. Cash expenses. We deduct the cash expenses from the sales. 180 million. 240 million. 270 million. Then we also have the interest charges. Interest charges 15 million. Deduct 15 million. Deduct 15 million. Deduct. We then deduct the interest charges. Okay, interest charges. Are we following? That clear? We are calculating the net cash flows, which we need to discount here to get the present value. Then the total will be the offer price. So we take sales, deduct cash expenses, deduct interest charges. I skipped the capital allowances. There is the capital allowances, capital allowances, capital allowances, capital allowances, 30, 45, 60. 30, 45, 60. 30, 45, 60. Those are allowances which ought to be deducted. Okay, we are deducting that. Then give me the total here. Year 1, 75 million. This is taxable. profit. Year 2. Year 2. Someone says 120 million. 120 million. Third year. Third year. 135,000. 135. 135 million. Then we tax. The tax is 30%. 30% tax. 30% of 75. 30% of 120. How much is it? Year 1. Tax year 1. Tax year 1. 22,500. 22,500. Year 2. Lucy K. 36,000. 36 million. Deduct the tax. Year 3. 4,500. 4,500. Right? 4,500. Now give me the difference. Deduct the tax from the taxable profit. That will give us the profit after tax. Year 1. 52,500. 52,500. Profit after tax. 52,500. Year 2. 84,000. 84,000. Third year. Third year. 94,500. 94,500. That is the profit after tax. Profit after tax. We then add back the capital allowances. Add back capital allowances. Add back the capital allowances. 30, 45, 60. Add back the capital allowances. 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 Add back. Then there is also the cash flows to replace assets. Cash flows to replace assets ought to be deducted. Cash flows to replace assets. Year 1. 37,500. 45,000. 52. 52,500. 52,500. The cash flows to do what? The cash flows to replace assets and finance growth. So these are outflows. So you deduct. What you get here is what we are looking for. So what will the net cash flows year 1? Net cash flows year 1. Net cash flows year 1. Net cash flow year 1. Kabasha, net cash flow year 1. Net cash flow year 1. Someone says 45 million. 45 million. Next, 84 million. The third year, what will be the net cash flows third year? 102 million. So these are the net cash flows which we are required to discount. Year 1 is 45 million. Year 2, 84 million. Year 3, 103 million. How about the discounting factor? The discounting factor, year 1 is just 1 over 1 point. The discounting rate, we have it 1 point. Is it 1.1? 0913. This is the factor raised to 1. Year 2 will be 1 over 1.10913 raised to 2. Year 3, 1 over 1.10913 raised to 3. Factors. Year 3, someone sells 1 or 2. This is 1 or 2, not 1 or 3. So what are the factors? Discounting factors. Discount. The discounting factors. Year 1. Year 3 is 102. But I had written 102,000. Just T says 0.9016. 0.9016 is the discounting rate. Year 2, discounting factor 0.8129. 0.8129, that's Kevin's answer. Year 3, 0.7329. 7329. Then discount. Multiply the cash flows, the future cash flows, by the discounting rate to get the present value. Year 1, how much is it? Year 1, don't round off. These are millions. Don't round off. 40,572. 40,572. Correct? 40,572. Year 2, 68,283. 68,283. 68,283. 68,283. 600. 68,283. Is that the position, or is it 0.6? Is this 600 or 0.6? Cannot be 600 because there are 3 zeros here. 68,283.6. Yes, Kabasha, that is true. Then the third year, Agostino says 74,755. 74,755 point something. 0.8. 0.8. 0.8. So these are 3 cash flows. Can we proceed? Yes. Now, we need to calculate the cash flows from year 4 to perpetuity. From year 4 to perpetuity. Look at the additional information number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year into perpetuity, in perpetuity. Now tell me now, what will be the cash flows here? What will be the discounting factor? And what will be the present value? That is your assignment. Give me the cash flows. That is your assignment, class assignment. You do it now. Give me the figure, please. Let me hear from each and every one. What will be the cash flows, future cash flows from year 4 to perpetuity? What do you think is the cash flows from year 4 to perpetuity? That's what we read in note number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4%. From our working, we calculated the net cash flows from year 1 to year 3. Someone, please, help me with the cash flows from year 4 to perpetuity. I needed the cash flows first. This cash flow, this one. And you are right, it is straightforward. Think you are right, Justice. It is straightforward. It is straightforward because this is what we need to write there. 102. It is straightforward. Okay? It is straightforward. But I've seen you've gone ahead to give us the present value annuity factor. You've gone ahead. Multiply, Hope says, multiply the CDS by 104. Multiply the CDS by 104. Now, I needed you to try that way. Multiply the CDS by 104. I think you are adding 100%. You are adding 4% to 100% to get 104%. All right. I needed you to try that way. Now, candidates, look at the question. It says, if Duet Limited acquires, the expected results from the cash flows will be as follows. We've seen the cash flows and the expenses. These are the cash flows, the sales and the expenses, and we have computed the net cash flows. At the end, after year 1, after year 2, that is the net cash flows. After year 3, we have the 102 million. This 102 million, the 102 million is what we are informed in note number 1, that is expected to grow or to increase by 4%. This 102 million, it is after the 3rd year. We are talking about 4th year, from 4th year, because these cash flows are at the end of the years. This is 45 million at the end of year 1, 84 million at the end of year 2, 102 million at the end of year 3. At the end of year 3 is the beginning of year 4. So we read here that from the 4th year, from year 4, from the 4th year onwards, it is expected that the annual cash flows from small limited will increase by 4%. So it is this 102 million from the beginning of year 4 that is going to increase at the rate of 4% into perpetuity. Now, in perpetuity means at the end of year 5, it will also grow at 4%. At the end of year 6, it will grow at 4%. At the end of year 7, it will grow at 4%. At the end of year 8, 4%. At the end of year 9, 4%. At the end of the 10th year, So we can go on and on into perpetuity, okay, continuously. So we need to calculate that amount, which we need to have it here, then we discount it. And to calculate that, we need to use this formula, P naught. The value of these cash flows will be equal to D naught. We are just using D naught, but you can use anything else, okay? It's D naught. Then we grow it at the rate of 4%. That will be into 1 plus the growth rate. Then we divide the rate cost minus the growth rate. This is the formula you covered in financial management. You recall when computing the value of cash flows that are running into perpetuity. This is the formula we use. If you are studying advanced financial management, this formula you used it and you passed the exam. That's why you are doing this paper. There was a question that was tested in your financial management paper which you passed. And this is the formula that you use to calculate the value of cash flows that are expected to be received into perpetuity. So this D naught is the present amount of 102 million. We grow it. The growth rate is 4%. 1 plus growth rate of 4%. 4% converting to decimal is 0.04. So it will be 1.04. Then we divide it by the rate. Okay, the discounting rate. I think we had it here. That is 0.01. No, not 1, but 0.1. 0.1. 0.10913 minus the growth rate 0.04. That will be the amount we need to insert at that point. Is that clear? Yes, Agostino, you had a point. A over R minus G. That is correct. So what is the cash flows? Someone says 1534. 1534 500. 1534 500. 1534 500. 1534 500 point 217. 0.217. So the factor here, discounting factor, this is 4 years, will be 1 over 1.1093 raised to 4. That will be the discounting factor. Raise it to 4. Raise it to 4. So what is the discounting factor? 0.66. Kevin says 0.6689. 0.6689. Present value, multiply that with that. Give me the present value 6608. 6608. 08. Present value. Present value. What's the present value? What's the present value? What's the present value? What's the present value? What is the present value? 1013. 1013. 1013 997 997 point something. 0.743. 0.743. Then the offer price. What is now the offer price? Get the total. present values, we'll have the offer price. And that will be the answer. The offer price. This the offer price. The offer price. Total will be the offer price. 1197. 1197. Someone says 1197. 1197 609 point something. 609 point 143. 143. That is the offer price. That is the offer price. These are how many marks? 8 marks. 8 marks. These are calculated values. Calculated values. Calculated values. All this just for 8 marks. Just to earn you 8 marks. 8 marks. Those are workings. You earn marks for correct entries. That is not to say that you should not show your workings. Your workings have to be shown. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Okay, 13 entries. 13 correct entries will earn you the 8 marks. Do you see why I said this paper was, the question was easier? Easy in terms of it will take you a short time to calculate. All these values are derived directly from the question. These ones you pick directly from the question. The only tricky bit that students maybe found a challenge, those who answered this question, was at this point. That was the tricky part. This point. Another trickiest part is this point. If you do not get the cost of capital correct, then all these values will be wrong. A student who didn't get the right weighted average cost of capital, then there is no way this would be correct. Okay, all these marks will be lost, including this. See, we have used it here to calculate that. You've used this to calculate this. Are you following? And you need to be very keen, and that's how the examiner tests papers. If you fail to get the right cost of capital here, then chances are, when answering this question, maybe the only answers that are not affected by this rate is this entry, and that entry. Just 3 entries. Do you understand? Any question? We are through with that question. Do we have any question? I think that last value is wrong. Which one? Which one? Which value is wrong? And you are the one who gave us the value. Which one? The last value? Justice, which value? Perpetuity? For year 4 to perpetuity. 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 He says this value is not correct. How did you arrive at this value? That is a formula. Can you please confirm? Can someone else confirm? You have to grow it. This one is growing at 4%. Any other question? Please take time, go through the questions that are related to this one in the past papers. If you come across any question that you are unable to solve, we can solve it together here on the board, but continue revising. You have enough time. Revise the past papers. Bye.